We got Khan from Luxor back on the show. Welcome back, Khan.
Thank you so much, Colin and Charlie. Great to be back on the pod.
Yeah, man. Thank you for joining us. So, y'all just published I'll get it up here, Charlie, your February look back series. And for anyone who is interested in data around Bitcoin mining, first of all, they sponsor the show, but we love Hashrate Index for all of our Bitcoin mining data. And these look back series are packed with insights from each month for changes to hash rate, difficulty, and mining economics. Also, Khan leads research and content at Luxor, and he puts out fabulous reports on a lot of the Bitcoin mining network. They just published their year-end report a few weeks ago. Recommend you check that out as well. But Khan, February was, for me, the most tumultuous month I've seen in Bitcoin mining, probably since somewhere around the China mining ban, or perhaps the halving in 2024. When you were compiling this look back article for February, what stood out to you as the most surprising find for the month?
That's a good question. There was a lot that happened in February. It was a wild story, both in terms of Bitcoin price and network difficulty. But what stood out to me the most was looking back on prior Bitcoin price cycles and sobering up in terms of where we might actually head for future Bitcoin price moves. We've seen that prior peak to trough cycles have had ranges anywhere from 75 to 85% in terms of drawdowns. And this has some interesting implications for where Bitcoin price might go in the near future and where hash price might land as well. So we'll get into a few of those details towards the end, but I found that to be the most surprising and personally sobering observation throughout this one.
I love these charts. This was what really stood out to me as well, looking at this for the reading this over for the first time. And I'll have this beautiful one where it's current Bitcoin cycles, price and drawdowns, November 2022, drop to the present, updated March 3rd. And right now, from the October peak, we're down about 50% when y'all publish this. And you also have this really good bar chart here that compares this to prior cycles. And this one currently is the third worst, at least in the modern era. I don't think y'all included data for anything pre-2017 because that would produce too much noise. But, within the last almost decade, this is the third worst drawdown in Bitcoin's history.
Yeah, exactly. And as you point that out, Colin, I'll get into it to talk about Bitcoin price. I think we can sum up February's story with two main points. The first is around Bitcoin price, and the second is around network difficulty. When it comes to Bitcoin price, if you scroll up a little bit, we'll see a Bitcoin price and network difficulty charts right here. So as you pointed out with those bar charts, we've seen the decline in February extend what is now the deepest drawdown in the current cycle. Back in October of 2025, we were at 126,000. In late February of 2026, we touched 63,000. So that's around a 50% drop from the peak that we saw back in October. Bitcoin opened at 78,000, declined by just under 24% throughout the month, and closed at around 65,000. We averaged $69,000. And obviously, this dragged down dollar-denominated hash price with it as well. So February marked a milestone that miners wanted to avoid, but unfortunately, we're back here again. We've seen new all-time lows in hash price. Hash price began the month at $34.91, ended at $28.57, touching a new daily all-time low of $27.89. And we averaged at $32.31, down 18% month over month. So that's the story with Bitcoin price. Obviously, mining economics from a revenue side are down bad. Now, if you scroll down towards the network difficulty section, this is where it gets very interesting. February saw a historically rare trend in difficulty, what we like to call a difficulty whipsaw effect. So what happens? Early in the month, on the 7th of February, we saw a significant difficulty drop, just over 11%. And this was on the back of two consecutive difficulty declines throughout January as well. Now, this provided temporary relief for miners. Bitcoin denominated hash price went up throughout this difficulty epoch, spanning from the 7th to the 19th of February. And this difficulty decline stood out as the 7th largest decline we've seen since 2016, which is what we consider to be the modern steady state ASIC era. Since 2013 to 2015 saw a lot of step changes in hash rate and difficulty as we transitioned from GPUs into FPGAs into ASICs. We look at this time period from 2016 onwards, and we see that February 7th decline ranked as the 7th largest decline in difficulty. So that's the first interesting point. But then what's even more interesting is the resolution and the rebound, which we saw later in the month. So just 12 days later, on the 19th of February, we saw a difficulty adjustment, positive upward difficulty adjustment of close to 15%, which brought network difficulty back up from 125.86 trillion to 144.40 trillion. And this ranks as the 12th largest positive adjustment since 2016. Together, combined, these two consecutive swings total a 26 percentage point change in network difficulty, which is the 4th largest back-to-back opposite direction swing we've seen since 2016. And it's essentially the most extreme difficulty whipsaw we've seen since the 2021 mining ban in China. All other previous extreme swings in difficulty were related to the resolution of the mining ban, which took place throughout the summer of 2021.
I really love this table as well for showing how severe that whipsaw is. And going back to the kind of the analogy or the analogous situation here with the China mining ban, you have an inverse of the mining economics at the time in terms of the fact that with the China mining ban, we had this crazy reduction in Bitcoin's hash rate and difficulty fell accordingly. And then it was so profitable to mine because of that people were revving up S9s and older units. Now, though, even though we had this massive difficulty reduction, it is still so brutal to be out there mining. Bitcoin's hash price hit an all-time low over the month of February multiple times. So for my next question I have for you, what does this mean for the average ASIC that's operating on the network today? Like, what generations from y'all's research are actually even still profitable at these levels?
That's a really good question. And to find an answer, we look at our quarterly mining economics projections model, which we provide every quarter. We refresh it every quarter, and it gives us 18-month interval projections for hash rate, hash price, and network difficulty. This is exclusively available to gold tier Hashrate Index Premium members, and it gives us a lot of insights around the hash rate supply curve that exists around the globe, which accounts for all machines that have been manufactured and that haven't failed, and also the active hash rate, which is economically viable as well. So I'm going to take you down towards the end of this article where we look at concluding thoughts. And Colin, I think there's two questions that are relevant here. The first is, at current hash price levels, do we expect more hash rate to come offline? And I think we have a pretty interesting insight here. Well, the first point that our projections model shows us is most legacy hardware is already offline. It's not as if they were hashing throughout the recent period and now turned marginal offline. And most legacy hardware has actually been offline already. Now, the rigs at risk of imminent shutdown stand at an efficiency range of around 25 to 29 joules per terahash. So this puts us into the class of around the S19 series and equivalent machines at the moment. What we find is that break-even efficiency at current hash price levels, assuming an average power cost of 5 cents, is around 24.5 joules per terahash. So any rig that boasts an efficiency above 24.5 to 25 joules is essentially underwater at this stage. So this means that from a practical perspective, we're looking at machines around the S19K Pro and equivalent. So that's one thing. Legacy hardware has already been offline. 25 to 29 joules is currently underwater. But then we also have newer generation machines, let's say spanning from 14 to 17 joules per terahash, which still boast profitable mining economics. So there is an incentive to still deploy these newer generation machines. So these two opposing forces are interacting with each other. On the one hand, we have an economic incentive to continue deploying newer generation machines, let's say the S21 series and equivalent. But then on the other side, we have marginal machines being curtailed and essentially forced out of the network at the same time. So the interaction between these two forces will determine net growth in difficulty and hash rate.
You know, one thing that I noticed from your machine breakdown by efficiency and break-even power cost is the choice of power cost at 5 cents per kilowatt hour. You're going to roll the clock back 2-3 years. That kind of assumed median price might be around like 6 or 7 cents. I don't know if you have any insight on like just the trend of lower power costs and why 5 cents is like the break even. Yeah, so I'm kind of curious if you have any thoughts or insight on that.
Yeah, so the power cost we get, this is an estimation that we provide for average industrial power costs that Bitcoin miners generally face. As we know, mining operations are highly sensitive to changes in power prices. Even a marginal change from 5 to 5.5 or to 6 cents per kilowatt hour is going to have a significant impact on mining profitability. What stands out to us is that this is forcing the network to get leaner over time. So we have legacy hardware, or let's say current generation machines ranging in the 24 to 29 joules per terahash efficiency ranges. They've now been made marginal. So they need to move out of the network. But at the same time, the machines that are coming in already boast profitability under most power price scenarios. So even if your power price is a bit over average, your efficiency, your fleet-wide efficiency makes up for it and still provides positive margin, which allows these machines to be continuously deployed. So we have more hash rate coming in from these new efficient machines that are able to withstand the current mining economics, whereas legacy machines are being forced out. So depending on your power price, if you have more efficient machines spanning from 14 to 17 joules per terahash, you can still make sense and deploy these for your operations.
Give us a ballpark or roughly estimate where y'all think hash rate is going this year. Because when I look at all of this, I would be shocked if we even crest the all-time high from October. Maybe not shocked, but I just don't see much room for growth here.
That's a good question. And we have two different sources that we can touch on. The first is the projections model, which anticipates slower, but still positive and modest growth throughout the rest of the year. And the main reason is because we expect to see a continued deployment of newer generation machines coming in, although this will be somewhat muted from legacy marginal machines exiting the network. In our projections, we provide 5 different scenarios ranging from Super Bull all the way to a stress case with base, bullish, and bearish scenarios in between. And I took an average throughout all of these scenarios, and we see that the model anticipates a year-end network hash rate of around 1.5 zettahash with a yearly average hash price of around $31 per petahash per second per day. So that's what our projections model is telling us. And then on the other side, in terms of nearer term expectations for the next 6 months out, our forward market is also pricing in further hash price compression. So the forward market is also expecting positive, but somewhat modest growth for hash rate and difficulty through to August 2026.
Yeah, if y'all like that, go to hashrateindex.com. Go to their blog. You can find this and other look back series. And you can also go to the research page if you're interested in some of the premium research or in some of the free research as well. Wealth of information with the data over there at Luxor. I always appreciate hearing what they have to say about market dynamics.